Financial Stability Report, it is published biannually by RBI. It is published every June and December. Published by Financial Stability Department of RBI, which works as a secretary to the subcommittee of Financial Stability and Development Council. So we will discuss about the FSDC in the later part of this video. Let's first understand what is financial stability as such. So financial stability has been defined by IMF. It is defined as the ability of financial system to facilitate and enhance economic process, manage risk, and absorb shocks. So enhance the economic process through creating financial assets or assuming financial liabilities by these financial institution or intermediaries, and it also manages risk and absorbs shocks in a more prudent way. Prudent means to do it proactively before happening on an unpleasant event. So the most important factor of financial stability is the interconnectedness or network of the financial institutes. So let's dwell into this concept. So a segment-wise analysis indicated that in general, long-term loans were provided by scheduled commercial banks to NBFC. Means scheduled commercial bank generated the financial asset, whereas NBFCs assumed the financial liability. So this is how you see there is an interconnection established between these two entities. If the NBFC defaults, it will have a greater impact on the balance sheet of scheduled commercial banks. So I hope this interconnection thing is clear through this particular explanation. Whereas asset management companies or mutual fund houses, they were the major investors in the equities issued by private banks and NBFC. So again, this is how the financial asset and liability network, financial liability network is established. And the third one is in the long-term debt market, the insurance companies, they were the major instrument, subscriber of the major instrument issued by the private bank, NBFC, or including HFCs. So here the insurance company, they invest in the debenture issued by these private companies, whereas these private companies like private bank, NBFC or HFC, they assume the financial liability. So in the long-term source of fund, we had long-term loans, we had equities, and then we have debentures. Now coming to the short-term funding. So in short-term funding, you have short-term loans, short-term deposits, commercial paper, certificate of deposits. These are the short-term sources of fund for the issuer. So mutual fund again continue to be the largest provider of fund in both the CP and CD market. So they were the largest provider. They created the asset in their balance sheet. Whereas AIFIs, NBFCs, housing finance companies, they were the largest receivers of the fund in case of CP market. So you know this NBFC and HFC, they cannot issue CD, they can only issue CP. Whereas public sector bank, private banks and AIFIs, they were the largest receiver of funds in the CD market. So the CP and CD market, predominantly the financial asset is created by these mutual fund houses, whereas liability is assumed by AIFI, NBFC and HFCs. So in total, if you see in terms of intersectoral net exposure, the asset management companies or mutual fund house, insurance companies like LIC and public sector banks, they were the largest fund provider. Means they have the receivables in their balance sheet if you net it off in the system. And NBFC, private banks, housing finance companies, they were the largest receiver of fund. Means they assumed the liability and they created the financial liability in their balance sheet. So among bank groups, public sector bank and urban cooperative bank, they had the net receivable position, whereas the private bank, foreign bank and small finance bank had the net payable position with the entire financial sector. So this is how these financial institutions, they tightly create a web, that is a connection, that is more known as a financial network. So this is more of a network which is being established by creating asset or by assuming the liability among the financial institutions. So let's look about the what is the outlook which is being given in the financial stability report. It says that Indian financial sector remained strong and resilient amidst the global headwinds. Banks and non-banking financial companies reinforced their capital liquidity buffer while improving their asset quality. Bank credit growth decelerated and moved closer to deposit growth, narrowing the gap between the both. So we'll discuss about the deposit and credit growth and how it got narrowed down. That also we'll discuss. The chart is there. We'll discuss in the next page. And the global outlook, the global outlook has deteriorated markedly amidst the headwinds from persistent trade friction, heightened policy uncertainties, and weak consumer sentiments. So headwind is something which is not good, uh, because it's coming against your favor, whereas tailwind is something which is favoring you. So it's more of an economic jargon. I thought it would be easier if I explain. So despite some easing in tariff tension on prospects of trade deals, the economic outlook remains fragile amidst the elevated trade uncertainties. This tariff war is going on, so this could adversely impact consumer spending, business investment, and financial conditions. So this is how the global outlook as of now. If we talk about the domestic outlook, means what about the India specific projections? So RBI has projected that the real GDP to grow at 6.5% in the financial year 2025-2026. But you need to note that the IMF and the World Bank, they have said that India will grow by 6.30% in the financial year 26, where RBI is projected that India will grow by 6.5% in financial year 2026, same as in 2024-25, supported by beyond rural demand, revival in urban demand, and upstick in the investment activity on the back of above average capacity utilization, government's continued thrust on capex, and congenial financial conditions. Because of these favoring points, Indian economy is going to grow at 6.5% in the current financial year. Further, financial stability report keeps on saying that it is estimated that 100 basis points slowdown in the global growth can, uh, ceteris paribus, pull down India's growth by 30 bps. So we are, of course, our growth rate is contingent on the global growth rate. If the global growth rate goes down severely, our growth rate may also be affected. So somehow it is connected. Here you may note that last year provisional estimate it is that during financial year 25 our growth GDP grew by 6.5%, whereas for financial year 2024 it grew by 9.2, then 7.6, 9.7, and 21 500 because of the COVID. Now the macro stress test which is there, generally financial stability report, they shows that when there is a macro stress test, when there is a stress in the economy, then what will be the impact on the capital adequacy ratio or capital adequacy of a bank. So this is the balance sheet of a bank. Banks, they generally give loans and advances. If a loan and advance is performing asset, then nothing worrying the bank, because the income generation will keep on enhancing the CRAR, your profitability of the bank. But when the loans and advances they impair, they get deteriorated, their quality become worsens. So what happens is this loss which is created, that has to hit your capital adequacy ratio in the first place. So that's why wherever there is a deterioration in the quality of the asset, it is directly going to impact your capital quality, your capital adequacy ratio. Your capital adequacy ratio is required to absorb the unexpected losses. So what you are supposed to, as a banker or as a learner, you need to note that what is the capital adequacy ratio of the bank, because there may be unexpected risk, there may be unexpected losses. So to absorb them, you need to have a higher capital adequacy. For the expected losses, you have provisioning, you have different allowances for that. But for unexpected headwinds, you need to have a robust capital structure with the bank. So it reveals that the aggregate capital adequacy ratio, means credit risk to risk weighted asset ratio of 46 major scheduled commercial bank may marginally dip to 17% by March 27, as compared to 17.2% in the March 25. So means it may come down by 0.20%, or what you say is 20 basis points under the baseline scenario. So this is a very important point which you need to understand and note also. So we discussed about the credit and deposit growth, that the credit and deposit this growth, that gap has narrowed down. So in September 24, when the FSR of December 24 was released, it said that in September 24 deposit growth was 11.5 and credit growth was 12.5. So means the gap was of 1% point. Whereas in this FSR of June 25, it is mentioned that your all scheduled commercial banks credit growth was 11%, whereas deposit growth was 10.7%. Means this gap has narrowed down from 1% point to 0.30%. So the credit growth has come down from 12.5 to 11%, whereas deposit growth has come down from 11.5 to 10.7%. If you see the composite of credit portfolios in agriculture sector, there is an advance of out of total advances, 13.1% goes to agriculture sector, 22.6 goes to your industry. Then you have 29.8 goes to service sector, personal loan being the highest among this composition, that is 33.11, and then comes the remaining 1.4 to some other sectors. This is how the composition of credit portfolio is. Coming to the NBFC generally they don't accept deposits. So credit growth in NBFC is 27%. NBFCs, they are only mid layer and upper layer. Base layer NBFC have not been discussed in this financial stability report. And when it comes to activity based credit growth in the MFI sector, because of so many restrictions, because the microfinance sector is not doing good, so restrictions are there. Because of that, the credit growth in the MFI sector has been minus, whereas investment in credit companies, infrastructure finance companies and infrastructure debt funds, the growth has been 24%, 19.4% and 17.7% respectively. Other key highlights of the report is that your gross NPA of the scheduled commercial bank on all the bank, means including PSB, private bank and foreign bank, it was 2.3%. Your NNPA was 0.50%. Your provision coverage ratio is 76.30%. Provision coverage ratio means your NPAs, means your bad quality asset. Say you have a bad quality asset of 100 rupees which has not been provided, so your provision coverage is 0. When say 50% provision has been created in the P&L account, if you create the free 50%, means you assume that loss prudently, proactively, then your provision coverage ratio will be considered as 50%. The capital adequacy ratio is 17.3%, whereas your leverage ratio was 7.9%. Liquidity coverage ratio needs to be 100% at least, but that was 132.6, and net stable funding ratio is 126.3. So what is your liquidity coverage ratios, net stable funding ratio, leverage ratio? These are the ratios which are introduced in your Basel III norms, especially after the global financial crisis. I have created a short on global financial crisis. Please do watch that. It is explained in less than 2 minutes, so it will be very helpful for you that why these types of norms were created. So liquidity coverage ratio is defined as the ratio of a stock of high quality liquid asset to the total net cash outflows over the next 30 calendar days. That should be minimum 100%. Means you should have enough cash with you to pay the liability which is going to be paid within 30 days. Your net stable funding ratio is defined as the ratio of available net stable funding to the required net stable funding, that is again 100%, and your liquid leverage ratio, that is the backdrop measure of your CRAR, because CRAR takes into account the risk weighted asset RWA, whereas leverage ratio doesn't count this risk weight. So it's a simple backdrop measure. It says that tier 1 capital to the total exposure should be a 4% in case of systematically important bank and a 3.5% for other banks. Now how the domestically systematically important banks they are decided on various norms. So one of the norm is like their balance sheet size should be say 2% of GDP. There is more interconnection between one bank, who means they have assumed so much of asset, so created so much of asset or assumed so much of financial liability with another financial institution. So based on the interconnectedness, the network, their balance sheet size, the domestically systematically important banks they are declared by RBI. As of now, SBI, ICICI, and in between HDFC. These three banks are there which are domestically systematically important bank. Now coming to the earning and profitability part, your cost of funds, average cost of fund for scheduled commercial bank was 5.7%, yield was 8.6, whereas net interest margin was 3.5%. For public sector bank it was 3%. I have created a video on NIM also, that what will be the impact on NIM with the backdrop of this reduction in repo. So you know that since Feb 2025 to June 2025, RBI has reduced repo by 100 bps or 1%. So what will be the impact on your NIM, your cost of funds? So please do watch that. Then return on equity is 13.6 and return on asset is 1.4%. So overall, financial stability report has said that your earning and profitability will be above average, and the banks they are doing well in terms of their asset quality as well as in terms of their earnings and profitability. Now coming to the NBFCs, the only middle layer and upper layer NBFCs they are covered. For these NBFCs, the CRAR is 25.8%. For NBFCs, generally 15% is the minimum CRAR requirement, and NIM was 5.2, return on asset was 2.4, return on equity was 10.6, gross NPA was 3%. If you compare the gross NPA of NBFC with the bank, it's 3% and 2.3%. So public sector, scheduled commercial banks they are doing better. Even the provision coverage ratio is better with this, whereas the provision coverage ratio is lower. Considering the fact that CRAR requirement are higher and CRAR is very high in the NBFC because they do not have a deposit as such, so they have the CRAR of 25.8%, whereas in public scheduled commercial bank they have CRAR of 17.3, and to counter that they have a higher PCR compared to NBFCs. The PCR is just 66.2, whereas here in the scheduled commercial bank it's 76.3. Now coming to the sectoral insight, this agriculture sector continued to record the highest gross NPA ratio and was the major contributor to the overall stock of the GNPA. So in the personal loan, highest the credit composition, highest credit goes to the personal loan segment. So it was moderate. It remained broadly stable across the major subsegments. The financial stability report of December 22-24 highlighted concern especially related to microfinance and consumer credit. Consumer credit is more of a type of personal loan only, which required the close monitoring, the financial stability report said in it. So regulatory measures to increase the risk weight on certain segment of consumer credit as well as on the bank lending to NBFC. So banks they do lend to NBFC. We have seen in the first this interconnected topic. We saw that is there. So because of that was enhancing. So what RBI did is RBI in November 2023 in the form of raising a risk weight asset, the regulatory measure RBI took that. The risk weights were enhanced by 25 bps. So because of that, the lending was more cautious to the NBFCs because that required a higher risk weight asset, which resulted in requirement of higher CRAR and higher credit cost. Higher credit cost was there, higher cost of capital was there. So because of that, because of that risk rate, the risk increase and banks became cautious while lending to the consumer credit segment as well as lending to the NBFCs, especially the unsecured loan, that is consumer credit. So the restoration in, I think in with effect from April, this risk weight was removed and earlier risk weight was restored. So this is expected to improve the credit prospect further. The FSR report says this, that with the removal of this risk weight, means this 25 extra BPS now it has been removed, so it will improve the credit prospect. Coming to the microfinance, microfinance is much talked about segment of recent times. So with the microfinance segment under stress, credit to the sector decreased by 13.9% in 24-25. Adoption of tighter underwriting standard by the lender was the primary driver behind the acceleration of the credit growth. The ratio of stressed asset in the microfinance sector increased in the second half of the financial year 25, with 31 to 180 days DPD rising from 4.3% in September 24 to 6.2% in the March 25. So you see the DPD, the 31 to 180 DPD has increased from 4.3 to 6.2%. So there may be the base effect to that, because the lending to the microfinance has gone down. So it may be one of the base effect, but it's a clear sign that the microfinance sector NPAs are above the industry average, and the microfinancial sector, it requires the close monitoring. Now, one interesting fact which was mentioned in the financial statement report of the last December 24, it said that nearly half of the borrower, they are availing credit card and personal loan, say consumer credit loan or other plastic money loans. They have another live retail loan outstanding. Means if you have the credit card loan, it is highly probable that you may have taken some car loan or some other type of vehicle loan, or say even housing loan or other type of retail loan, which are often high ticket loan, for example housing or vehicle loan. So given that a default in any loan category result in another loan of the same borrower being treated as a non-performing by the lending financial institution. So as per RBI norm, if you are Mr. X has a credit card with say bank A, and with the bank B it has a say a vehicle loan. So if this loan of with bank A turns NPA, say a credit card turns NPA, then of course automatically your vehicle loan, it will also turn NPA even though you are servicing it properly. This is how it works. This is how the regulations are. So RBI at that time required in FSR those NPA, especially generated to credit card, they required close monitoring, because they have trickle down effect on the other loan of the same borrower, Mr. A. So that you need to take into account that all these slippages will pass on in the financial system. So first default is mostly observed in the unsecured advances among the borrower at risk of default, means advance in SMA category, and the risk of delinquency is trending high among the borrowers who, in addition to a personal loan or credit outstanding, have availed other retail loans. Means if in such case, when Mr. A has a credit card loan from bank A and a vehicle loan from bank B, in such type of cases, more close monitoring is required, and this the evidence they explicitly shows that the risk of default is higher in such type of cases. What are the other highlights of the financial system? The insurance sector remained robust. It had a robust solvency ratio, indicating the minimum requirement is 150 for life insurance industry. It was 204% as on December, whereas for non-life insurance industry it was 166% only. Coming to the government finance. So on the fiscal front, India's public debt level, primary deficit and share of interest payment in the government revenue have remained relatively on the higher side compared to the peer emerging market economies. India's fiscal position and credibility has enhanced significantly in recent years on account of ongoing fiscal consolidation, improvement in the quality of expenditure, and earmarking of debt to GDP ratio as the nominal anchor for the central government fiscal policy. Earlier, fiscal deficit was the nominal anchor, but the one limitation with the fiscal deficit was it did not account the off-balance sheet exposures. So this is one of the factor, and fiscal deficit was year on year. Means for every year it was a different target. So for longer run, what you are required to have a debt in your debt composition of your GDP. So debt to GDP ratio will address both these. Fiscal risk is more of a short-term measure, when debt to GDP is it's a comprehensive measure and it doesn't ignore off-balance sheet exposures. Though in recent times the off-balance sheet exposures have reduced to a significant extent. Coming to the external sector, the resilience of external sector has been a key contributing factor to India's macroeconomic and financial stability. Current account deficit stood at 0.6% in 24-25. It remained eminently manageable, supported by sustained buoyancy in service export and remittance. External debt to GDP ratio of India was 19.10%. Coming to the inflation, so the domestic inflation has been steadily declining with the headline consumer price index CPI. It is a 6-year low of 2.82% in May 2025. The last such inflation was observed in Feb 29. So after 2019, Feb 2019, we have observed such a low inflation. It is a very incredible thing to achieve. The outlook for food inflation remained favorable and on account of softening prices and robust crop production. Moreover, the risk of imported inflation largely remains low, with the anticipated slowdown the global growth likely to soften the commodity and crude oil prices. Although the recent escalation of geopolitical tensions in the Middle East had led to the heightened uncertainty, the near-term and the medium-term outlook gives greater confidence of a durable alignment of the headline inflation within the target of 4%. The RBI target is 4% and the boundaries are plus minus 2%. So this is the range within which we need to have our CPI. Now coming to the systemic risk survey, this is a specific type of survey which is conducted in the financial stability report. The survey is more of a perception of major vulnerabilities of the Indian financial system. What is the perception of public of the institutes? So systemic risk has been defined by the IMF, Financial Stability Board, and Board of Bank of International Settlement. This definition is there. The systemic risk is defined as the risk of disruption in the provision of financial services caused by an impairment of the financial system with serious negative effect on the real economy. That the financial system is so much deteriorated that it had a real bad effect on your economy, even though your economy may collapse. This is also known as domino effect or contagion effect. So what are the risks to financial stability? So these are the risks which were provided in the financial stability report of December 24. This green light, this highlighted, these are the risks which have now no more relevant. These are not there. That is inflation concern. We just saw it that after Feb 2019 we had the lowest CPI. So this inflation concern have been addressed. And the second point was consumption demand, that there is no demand for the consumption. So that is also addressed out because there is now much surplus in the economy. You have the tax measure or fiscal measure to address this. And there is manufacturing, the PLI and other schemes, their support have been given by the government to stimulate the consumption or demand. So these types of risks, they have been addressed to a great effort. So other types of risk, they remain. Now this is the risk, that is the rise in the US. This is the new types of risk which is stated in this financial institute report of June 2025. Now what will be the impact of rising US yield? So when the US yield rises, means the dollar will rise, the rupee will depreciate. Now if the rupee is depreciated, so it's good for exporter, the Indian exporter. It is a very good sign that rupee depreciate, but it's not good for importer. So India has current account deficit, means here our imports are more as compared to our export. So as an economy as a whole, if you see, our import, the cost of import will go high, the inflation will go high, even our current account deficit will go high. So from an economy perspective, this is not a good sign. That's why this is a risk for us. But if you see the interest rate parity, then in the long run, long run, if the bond yield goes up, US bond yield goes up, rupee will strengthen. But that is more of a theoretical explanation, but it will sustain only in the long term. But in the recent medium or short term, this will be the implication. Even when the dollar appreciate or US yield goes up, the foreign portfolio investors, they will also pull their money out of the emerging economies like India, and they will go to the advanced economies like US. So these are the instant, if you see what may be the impact on the Indian economy as such, this is how it can be explained. Now coming to the other point, as I told that we'll discuss about the Financial Stability Development Council. This is there is the Financial Stability Department in the RBI that works as a subcommittee of the FSDC. RBI works as a subcommittee to the FSDC. Now what is FSDC? FSDC recently in June, if you remember, I have created a short on that also. Recently 29th FSDC meeting was held in June 25. So FSDC was established in 2010. It's an executive body, it's a non-statutory body, it's an apex level body by the government of India, the aim of which is to strengthen and institutionalize the mechanisms for maintaining financial stability and performing financial sector development. Recently, the Financial Stability Development Council gave instruction that the unclaimed financial asset, be it deposit or insurance claim, they needs to be settled, they needs to be wiped out of the system, and the beneficiary should get benefited out of those. Who are the members? The members are Union Finance Minister is the chairperson, then head of financial sector regulator like RBI, SEBI, PFRD, IRDA, FMC, and then Finance Secretary and SEBI economic advisor. I think FMC is merged with SEBI now. It can invite expert to its meeting if required. What are the functions? It monitors and addresses systemic risk in the financial sector. Systemic risk definition we have already discussed. Financial stability definition we have already discussed. So functions are to enhance and the growth and efficiency of the financial sector, to facilitate coordination among the financial sector regulators, to resolve inter-regulatory issues, and to strengthen the mechanisms for dealing with the financial crisis. So one important point which I thought will be useful for you is the definition of personal loan. As per Financial Stability Report, the personal loan is defined as a loan given to individual and consists of consumer credit, education loan given for creating an enhancement of immovable asset like housing loan, and loan given for investment in financial asset like you invest in share and debenture, and for that you require some loan. So all these types of loans are categorized as personal loan as per the definition given in the Financial Stability Report of June 25.